Hi everybody, my name is Joe Piszczor, Certified Financial Planner and owner of Washington Family Wealth here in Washington, Pennsylvania. I wanted to bring you a short video here on November 4th, 2024, Election Eve, and just share some opinions and some things that I noticed in the economy, as well as some pointers for everybody as we navigate through this very fun election season that we've all been subjected to. So anyway, without any further ado, I'm going to jump right in and start with the current economy and the current market conditions. So on your screen, you can see the four indexes here that I wanted to present. First, the green one at the top is the S&P 500. Year to date, it's up 21.47, about 21.5%. So great year for the S&P 500. That represents our large corporations. So, our large companies in the U.S. Specifically. Next, we have I guess it would be purple line. That is the mid-cap index, so the S&P 400. That represents mid-sized companies in the U.S. It's up about 12.92% this year, so solid year for mid-caps. Lastly, our international index, excluding the U.S., at 7%. So the U.S. has outperformed its international trade partners 3-1 this year, so good on U.S. companies for that. And then lastly, in blue at the bottom is bonds, or the aggregate bond index, and that's up 1.4% for the year to date. And typically we own bonds for yield, not for capital appreciation, but just looking, it's an important index for us to cover, and we can see there 1.4% on the ag. So anyway, one thing I wanted to share and start with was this, that and you can see on your screen here, this is the S&P performance since 1933, so right after the Great Depression. This is what the economies did. You can see in each band, that is whether it was a Democratic or Republican presidency. And no, we're not projections or anything like that, but what I wanted to talk about here is that the stock market is not partisan. The economy has grown under Republicans and Democrats alike, and for us that make financial plans for folks, it is important to make plans that work regardless of whom is in office. So when we develop your financial plans as CFP professionals, our goal is to make sure that those plans work regardless of who gets in office, and that we make long-term goals. And normally corporate profits, interest rates, and monetary policy are going to drive the economy, not necessarily who's in office or what party's in office. So I thought that was interesting and wanted to share that. So the next chart I wanted to share is GDP, so gross domestic product. How much is the U.S. producing? And what we can see here, if we go left to right, that first little dip is 2008. So it certainly slowed our economy going through the housing crisis. And in fact, have many reciprocal effects from the housing crisis, right? U.S. home producers have not produced homes up to the level that they had pre-2008, and that has left a gap in the housing market and higher inflation rates on homes in the U.S. So just a little point there. Now, the next one we see is the COVID pandemic, that very sharp drop in 2020 and back up, big hit to GDP, but you can see we've recovered our GDP production as well as the growth rate for it, which trends around 2.1% long term. So we're growing the economy at a fair clip, and hopefully we're figuring out how to let everybody participate in it. To the right of that, you can see how our GDP breaks out. So 4.1% housing, 14.2% investment excluding housing, 17% is government spending. This is always surprising to people. 67.8 is personal consumption. So you see a large chunk of our GDP is the spending that all of us do in the economy. And many times economists look to consumer spending to see the health of the economy. Is the economy healthy or not? And are consumers still spending? And believe it or not, I bet you could believe it, consumers have remained resilient with their spending post-pandemic. So Americans have continued to spend spend money in the economy, even with inflationary pressure, even with wage pressure, even with job pressure. And with that, let me transition over to jobs. So JOLTS report, it sounds cooler than it is, but the job openings and labor turnover survey is a comparison between the job openings that are out there with the new hires that are being hired, the people quitting, and the amount of layoffs in the economy. So what we can see is that big spike in rehiring after the economy and people looking to fill positions that were left vacant in the economy after that huge spike in unemployment during the pandemic. What we've seen most recently, though, and if you look to the hires and the quits, we've seen a trail off in new hires, and we've seen a trail off in folks quitting their jobs. So if you remember, during the pandemic, there was a lot of job shifting and people seeking new employment or better employment during that time, during and then after. And now you kind of see a more normalization. What remains to be seen is, do the job openings stay where they're at, continue to go down, or renormalize? So if you looked at a trend line on that purple line, where are we going to settle out when it comes to the the continued job openings in the economy? And I'm sure our respective political candidates would have a lot to say about that. But anyway, this is an important report. If we look to the unemployment rate, which is another important component of the jobs landscape, we are at a 4.1% unemployment rate. The average long-term is 5.69. So we are technically at full employment for the U.S. And obviously there's some arguments on both sides with that number, whether it's good or bad. But I mean, all things being equal, unemployment rate is extremely healthy right now in the U.S., and that is contributive to a strong job market, which many economists have talked about the strong jobs market being helpful in getting us through and out of the COVID pandemic. So anyway, we'll see where it goes from here. Next, I want to talk about interest rates. So the Federal Open Market Committee has seen fit to cut interest rates in their last meeting at 50 basis points. So that's normally double what they normally move at. They usually move in 0.25% increments. And for those not familiar with the FOMC or the Federal Open Market Committee, they set rates and issue debt. Those are their two main things to help control the U.S. economy. And I like to look at it like a train conductor. They can issue more or less debt, and they can increase or decrease interest rates, either making it easier or harder for businesses to work in the U.S., as well as affecting consumers. So those rates that they set, the Fed funds rates, and how the rates that set how banks lend to each other to meet their overnight deposits, those rates set everything else in the economy and kind of drive which way interest rates are going. If you remember, when rates increased during the pandemic, CD rates went up, mortgage rates went up, credit card rates went up, auto loan rates went up. So all rates, whether you're on the paying side of that debt or the receiving side of that debt, all went up subsequently. So we're starting to see rates coming back down. Good for those that are planning on taking out debt, corporations, home buyers, those with consumer debt, student loans, all those things. Bad for depositors and those investing in debt. So bondholders, cash investors, things like that. But and we'll talk a little bit more about cash investments later on. But definitely something to take heed of is that interest rates are on their way down currently, and the Fed can always change their mind. So, but they do have a meeting coming up, I believe this week, and then they had projected to cut rates 2 more times at 0.25%. We'll see if their projections stay true. But that is typically a sign of economic strength, because if they're cutting rates, they're confident in the way they see the economy heading. Next, let's take a look at, I wanted to look at inflation. So now inflation is currently at 2.4%. The chart you can see here is many different factors, but the blue line, the light blue line is food, the red line is items, excluding food and energy, and then the dark blue line is everything. So you can see that big hump during 2020 for COVID and the spike in all of the CPI. So this is the CPI, Consumer Price Index. So when we look through that and look at where that inflation is falling on this inflation components chart, you can see where much of our inflation has been coming from over the past few years and post-pandemic. So after the pandemic, a lot of the inflation we experienced was from energy sector and core goods. So a big spike in core goods and food prices. So that is a lot of what Americans have been experiencing. And the reality is, here's where we're at. So we are currently year over year at 2.4% inflation. So if I look back 1 year, the current rate is 2.4%, which is not bad long term. However, what we're not seeing, or what most people fail to see, is the stickiness of the inflation that we've experienced. It doesn't necessarily go away. Prices don't go back to their previous amount. So if we look at how much sticky inflation Americans have experienced, all of our budgets are on average 21.4% higher than they were pre-pandemic, which is a massive impact, whether you're just starting out in the accumulation phase and starting your first budget and first savings plan, or if you're well into retirement. That is going to impact you and your financial plans big time. And we're seeing that with all clients across all demographic levels. And the pandemic was the first major shock to inflation that we've seen since the late 70s, early 80s. So it's very important as I transition to our tips and tricks to take heed of that. So anyway, I know I threw a lot at you as far as what's going on in the economy, and I know we're all exhausted from being inundated with election asks and information, but I did want to get out some economic data for everybody to consider. But let me transition to the tips and tricks and things I think are important for all families to consider right now as we wipe our brow from the election and move forward into our next phase. So, like I mentioned, 21.4% inflation is a lot to eat for any family. And a lot of this inflation may not ever go away, regardless of what party or what people get into office. And that is normal, right? Inflation sticks around forever. And we hope that some prices go back, but the reality is that they probably won't. Take time now that we've had a few years since the pandemic to look backwards on your family's budget and see what you're truly spending. Go through your check register, look at what you're actually spending in your accounts, and see what is our current budget. You might need to make some adjustments to it, you might not, but the reality is we're having every client update their budget and take a hard look at what are we truly spending now, because it can make major adjustments in your financial plan. That being said, we've made adjustments to our plan assumptions, and we are estimating inflation higher, as well as many other economic shops are. We're assuming higher inflation moving forward for that reason. Two, it's a great time to do a risk assessment with the markets surging over the past couple years. I see a lot of folks coming in that haven't worked with a professional. Their portfolios are either way too aggressive or way under risk, or not aggressive enough to get to their goal. What risk you take on, what return you plan on getting, and how that plays into your long-term goals are all very intertwined. And now is a great time to do an assessment, see where we're at. Like we saw, the markets are not partisan. They're going to do what they're going to do regardless of who's in office. So take time, do a risk assessment, make sure your chips are on the table where they need to be, and that you're taking on an appropriate amount of risk, and that you're systematically rebalancing to stay within that risk parameter. Because as we see big swings in the market one way or the other, we see people families getting off of their projected risk tolerance level or projected asset allocation. So something to think about. Lastly is a cash strategy. I know it sounds boring. I know people are sick of hearing me talk about cash, but interest rates are still at very high levels. If the Fed is starting to cut rates now is a great time to take a look at your cash reserve and your cash assets and make sure that they're keeping up with inflation, because the reality is if you have cash assets, and we have a lot of sleepy assets out there that are just sitting in checking accounts making 0%, those assets have been subject to all of this inflation we've had the past few years. So looking back, hey, I may have lost 15% or more in spending power in my cash reserve by just leaving it in my checking account. It's still the same dollar amount that I left in there. It just can't buy as much as it once did. And when we have a cash reserve that's bleeding because of inflation like that, and thank goodness we're in a more normalized interest rate environment to where we can go and get at least inflation in an FDIC guaranteed product like a CD, a savings account, a money market, that gives us a lot of flexibility to do other stuff with that cash, right? If I don't need to put money into my cash reserve every year, I can put that toward paying down debt, putting it toward a long-term goal or something else. So with that being said, check your budgets, do a risk assessment, and make sure that your cash is not on the sidelines and that your cash reserve is at least keeping up with inflation. I'm Joe Piszczor, certified financial planner, accredited investment fiduciary analyst. Thank you for your time, and hope everybody has a great election day. Bye-bye.